Dear students, let us now discuss about our new and last module, portfolio selection. Last class we already discussed about what is portfolio. It is the combination of different securities with different return and risk. Let us discuss what is the criteria for selecting portfolio. There are two. First one is highest return at the lowest risk. Second one, risk return preferences. Next, we discuss models of portfolio. There are two. First one is Markowitz portfolio utility theory. It's also known as efficient frontier. The second one is Sharpe's optimization. Markowitz efficient frontier. There are two stages of efficient frontier. They are first one, construction of efficient frontier. Second, selection of the optimal portfolio. Construction of efficient frontier. Each portfolio in the portfolio set has an expected return and risk. Risk is also known as standard deviation. Portfolio grouped into two categories, efficient frontier and inefficient frontier. An efficient portfolio gives the highest portfolio returns for a given level of portfolio risk. An inefficient portfolio are dominated by efficient portfolios. Now let us look upon meaning of efficient frontier. The efficient frontier, also known as the portfolio frontier, is a set of ideal or optimal portfolios that are expected to give the highest return for a minimal level of return. This frontier is formed by plotting the expected return on the y-axis and the standard deviation as a measure of risk on the x-axis. It evinces the risk and return trade-off of a portfolio. For building the frontier, there are three important factors to be taken into consideration. And the first one, expected return. Variance, standard deviation as a measure of the variability of return known as risk. The covariance of one asset's return to that of another asset. So these are the three important factors. Other than these three factors, we have about the model. This model was established by the American economist Harry Markowitz in the year 1952. After that, he spent a few years on the research about the same, which eventually led to him winning the Nobel Prize in 1990. Now we have the graph on efficient frontier. So this is the graph which has been depicted clearly on the slide. And here on the top box, we have each point on this line represents an optimal combination of securities that maximizes the return for any given level of risk. And the downward box explains the dots represents portfolios that are inferior to the portfolios on the efficient frontier but with more risk or less return with same risk. Now that example, the efficient frontier graph shows an example which appears here. Note how the efficient frontier allows investors to understand how a portfolio's expected return vary with the amount of risk taken. The relationship securities have with each other is an important part of the efficient frontier. Some securities prices moves in the same direction. under similar circumstances, while others move in opposite directions. So, here we explain about the efficient frontier graph, that the investors will be choosing only the investors will be choosing only the investment which is shown in the efficient frontier. Next, some portfolios having the same expected returns but their standard deviation, that is risk, differs. The northwest boundary or region where the efficient portfolio exists is called efficient frontier. That means the efficient frontier will be having the most optimal portfolios existing. And on the downwards, it is not much a best one. So thereby the investors will be choosing their investments. Selection of optimal portfolio. Rational investors will obviously prefer to invest in the efficient portfolios. The particular portfolios that an individual investors will select from the efficient frontier will depend on that investor's degree of aversion to risk. The process of selecting the optimal portfolio from efficient frontier is portfolio selection. Sharpe's optimization, this is the second model. This optimal portfolio of Sharpe is called the single index model. The optimal portfolio is directly related to the beta. If RI is expected return on stock I and RF is risk-free rate, then the excess return is equal to RI minus RF. Next, excess return to beta ratio is equal to Ri minus Rf divided by beta I, which is the equation for ranking stocks in the order of their return adjusted for risk. The method involves selecting a cutoff rate for inclusion of securities in a portfolio. For this purpose, excess return to beta ratio given above has to be calculated for each stock and rank them from highest to lowest. This then only those securities which have Ri minus Rf divided by beta I greater than cutoff point fixed in advance can be selected. So this is about the portfolio selection, and hope you all understood the portfolio selection topic. If you have any doubt, please clear through Google Classroom, and thank you.